Welcome to Taking Stock for the week ending 7th of June 2024, where this week myself, Tim Lincoln, and Kien Trinh stream to you all things share market. Welcome, Kien, and how are you, mate?
Yeah, not too bad, Tim. I'm just trying to avoid the flu season at the moment. It's difficult when you have kids at school, but I hope you and all our investors are doing well during this time.
Yeah, same with me, mate. I hope all of our investors are well out there too. And excuse my voice this week because I think I've got a little bit of the lurgy, as have, a lot of our staff at the moment too. So it's that time of year where plenty of flus and whatnot are floating around. But before we get started, Kian, we've got a lot to get through today. Really exciting edition of Taking Stock. All of the information that we share with our members today, of course, is of a general nature and should not be relied upon as a guide for personal advice, and all of the data and information that we also share, all historical in nature, and likewise should not be relied upon as a guide for future performance. But Kien, markets have been really wild again this week. It's really a very tough environment to make a whole lot of sense out of, with a raft of weaker economic data suggesting that the earnings environment remains incredibly challenging. And this was highlighted in our Taking Stock episode last week, where we showed the acceleration in negative earnings revisions in recent months. So really taking off. Yeah, and you can see on the chart on the screen, which compares forecast earnings for the market in the black versus the all ordinaries in the blue, which is showing that disconnect occurring. And despite the weaknesses in the fundamentals, Kien, the Australian market continued to trade near highs, which is just crazy at the moment. This does not make any sense to me at all. And I can't help but think that much of this momentum, Kien, in the markets is driven by passive investment, index funds and ETFs, those exchange traded funds out there where the sheer weight of money is continuing to drive markets north against the fundamentals. So irrespective of the fundamentals and the financial health of businesses, this is all creating a real herd mentality or fear of missing out, or it's just simply passive flows just driving the market north relentlessly. And it's a phenomenon, Kian, that we haven't seen before. We've never been in this environment. Normally when there's this disconnect between fundamentals and equity prices, that can lead to a very bearish environment or a stagnant environment, especially when you consider the gyration in the expectations around interest rates and inflation and all of those other factors. It would normally lead to either a bearish environment correction, but it's not. The sheer weight of money is pushing things north, and it's something that we haven't seen with 70% of all flows now going into passive, which is having a massive influence.
Yeah, that's right, Tim. The growth of ETS has been a contributing factor to this disconnect between share prices and fundamentals. And the market, it's just become so excited, with the fact that, this week you had the ECB and also Bank of Canada cutting interest rates. But things don't make much sense, as you mentioned, because, GDP growth, especially the ones released this week to March, came in, very slow at about 1.1%. The market doesn't really think that this impact of slowing economic growth is going to have an impact on corporate earnings, which doesn't make sense, Tim.
No, Kian, it's just a crazy environment, isn't it? But we also need to focus on the facts rather than the headlines, but back to the bottom-up fundamentals and the numbers rather than a lot of the macroeconomic noise, which is leading to us to quite a confused state at the moment. If we drill down into the below the market surface, Kien, we can see that most of the rally over the last year has been driven predominantly by the large caps, or what they call the mega caps in the US and also here in Australia. You can see that this clearly on the chart on screen, where we're comparing the performance of the largest 10 stocks in the US versus the rest of the market over the last 3 years.
Tim, yeah, and similarly in our Australian market as well, there has been a significant outperformance of the large 20 stocks compared to the rest of the market, the small ords as well. This tells me that the overall market breadth is still quite weak, while all the passive funds, as you mentioned, and ETFs are artificially driving the larger cap stocks higher, which, over the longer term is unsustainable.
Well, it has to be unsustainable, doesn't it, Kien? It's,
Mm.
with 70% of all flows now going in, money flows going into these ETFs, which are market weighted. So we've got to remember that. That's what, because they're market weighted, most of the money goes into, roughly 20% of the markets, which pushes those larger caps up just because of that sheer weight of 70% of all money into this passive flow. So sustainability, I don't know, you wind the clock back 10 years and it was probably 20 or 30% of flow. Now we're at 70. What level will it get to before it actually pops? And even Jack Bogle, the founder of index investing, which this is all about, passive as index or ETFs or whatever way you like to look at it. Jack said that if everyone invests in passive, the market will break. So what is that breaking point? And that's the thing that makes us really nervous, and hence why we're still hedged. But the problem is we just don't know how long it's going to last. But, it is very much an artificial environment at the moment, which does make us pretty nervous. However, Kien, we are bottom-up stock pickers at the end of the day. All portfolios, it doesn't matter what environment we're in, have got a whole quality company. So let's turn our attention to a few star stock highlights. And over the week, we've seen some share price pressure on our energy stocks like Karoon Energy and Woodside Energy. Is there something investors need to be mindful of here?
Yes, Tim, the weakness is attributed to the underlying oil price, which has fallen quite drastically over the week. And this was driven by the outcome of the OPEC meeting. So they're indicating that they will start phasing out voluntary production cuts from October. So what this effectively means is that there could be more volume returning to the market by December, and there is a potential increase in supply, and that's pushing down oil prices further. But our team of analysts are currently assessing the situation, Tim, and especially the impact to the forecast earnings of our star energy stocks. Note that Karoon Energy, they've experienced negative earnings revisions just over the last couple of months, and that's due to after they downgraded their production guidance and from the recent acquisition of Brazilian oil producer called Who Dat. But we are definitely monitoring this situation.
Who Dat oil producer?
Anyway. Yeah, Brazilian oil producer. Yeah.
No, just having a bit of a joke there, Kien. All good. Who Dat? Thanks, Kien, for that. And Treasury Wines provided a trading update this week with management reaffirming their financial year 24 earnings guidance, which is great. What did you glean from this announcement, Kien?
Yeah, our borderline star growth stock, Treasury Wines, management did reiterate their guidance for mid-single digit earnings growth, which is roughly where consensus is. But the real kicker was that there were comments relating to the US market, which suggests that Treasury is outperforming, and they are recently, given that they've acquired this winery called Dow, which has scope to expand outside of the US. So there were a bit of concerns around that, but it looks like the concerns have been mitigated.
Who Dat Dow? Anyway, no, interesting names being thrown around there, which is obviously another jurisdiction. So very interesting. Just having a bit of a play on words there again. Sorry, a bit of dad humor kicking in. But yeah, Treasury Wines, the numbers on stock doctor, you look at the golden rules 2 and 3, and the numbers aren't, they don't shine as much as some of our other star stocks, but obviously with their premium brands, it's a really good, solid business and one that we really like. However, some of the growth metrics may not, as I just said, pop compared to some of our other star stocks, but just an observation there. Another company to release an update this week, Kien, was education provider IDP Education. Regulatory headwinds prompted management to guide for flat earnings in financial year 24, which represents an 8% or so downgrade from consensus forecast, Kien. No doubt this will lead to further negative earnings revisions, so keep an eye on that number under Golden Rule 3 and the trend under Golden Rule 4. And so, Kien, are you able to provide our members with an updated view on the stock, considering that's pretty hot off the press?
Yeah, Tim, the share price was definitely quite volatile during this week. And we've held this view that the earnings forecast for IDP have been optimistic given the risk of slowing migration, hence why the stock isn't a star growth stock, because we felt that the risk was quite high on this stock. But And that's probably why the reason why the short interest on the stock is also so high at over 16% as well. But with the Australian government targeting net migration to decline by about 34% in financial year 25, it was no surprise to see management forecast a rough 20 to 25% decline in student placement and English language testing volumes over the next 12 months. But all in all, this disclosure points to more cyclical factors as political and regulatory changes, they tend to normalize over time. So there remains a strong underlying demand by international students wanting to study and live abroad. Hence, we see this current setback as more of a short to medium term issue, Tim.
And now to Under the Microscope, Kien. And this week we take a look at an emerging opportunity, which can be found under My Growth Stocks with Potential filter. So navigate to the stock filter and scroll down to the left there and you'll see my Tim's Growth Stocks with Potential filter. And the business is a biopharma company called Telix Pharmaceuticals and uses nuclear medicine, which sounds pretty nasty and intense, doesn't it, to diagnose and treat common cancers in patients. I noticed that its financial health Kien has moved from distressed to strong over the last period, but we must note that it is over only one period thus far, and hence why it can't be considered as a star growth stock at the moment.
Yes, Tim, if you think about the business, most of its income is derived from an imaging agent, and it's called Illuccix, which is a radioactive drug used to treat men with prostate cancer, Tim. And following the approval from regulatory authorities in Australia, the US, and Canada, the company has generated very strong operating profits and cash flows, which has offset some of that weaker balance sheet metrics under our financial health model, such as TLTAI, Tim. And although the business doesn't have much debt, right, other liabilities such as contingent liabilities have weighed on the balance sheet ratios. And these are liabilities created from previous acquisitions, which had payments contingent on certain clinical and commercial milestones, Tim.
Yeah, hence why our gearing ratio, TLTAI, looks a little unsatisfactory at the moment. And under Golden Rule 3, Kien, the company has experienced large upward earnings revisions as well, which is terrific to its consensus estimates, with the stock well covered by 8 analysts, so we can have some faith in those outlook figures under Golden Rule 3. So what is driving, Kien, the earnings upgrades?
Yeah, just recently, Tim, and those strong earnings revisions have been driven by favorable results in the company's PROS-ACT Select trial. And that's the complementary product to its core product, Illuccix, that offers a differentiated antibody therapy. And this has led to that strong share price rally.
Terrific, Kien. It certainly has had a strong share price rally. And also supporting the share price has been news that the stock plans to list on the NASDAQ in the US. So very, very impressive. Despite the positive earnings momentum, investors need to be mindful, though, of the lumpy nature of earnings, which can be seen under the earnings trend under Golden Rule 4. You just need to select EPS forecast 12-month field and see the trend in the bottom. And I suggest you have your range there to 1 year, so you see the earnings trend over the last year.
Yeah, it's quite lumpy there, Tim, but this isn't surprising given that earnings are driven by the success of clinical trials, and also there's significant research and development spending, and also dependent on FDA approvals as well. But under Golden Rule 5, Tim, I noticed that the stock is trading at a slight premium to consensus fair value. And also investors shouldn't rely too much on the stock's high PE multiple as well, currently at around 88 times, because this can quickly come down if the strong growth forecasts are achieved.
Yeah, I mean, it's early days for it with only one period of financial health, but sometimes, you want to get into these stocks early if there's a high probability that they may come into our star stock universe in the not too distant future. And based on that valuation too, Kien, sometimes you've got to pay a premium for quality. And from a management perspective, it's also great to see that CEO Dr. Berenberg, I think that's the best way to pronounce the surname, has significant skin in the game with 7% of equity stake in the business, which is terrific. Dr. Berenberg has also a really strong track record of running biotechnology companies, having been CEO of Miranda Medical, Momentum Biosciences, and Adaptix. And you can view all of that by clicking on his name within the corporate details area or under Golden Rule 7. And now to question of the week, Kien. And under Golden Rule 7, an important component of your stock research is the understanding director buying and selling activity. Really important, which may raise red flags from time to time about the business. So the directors selling or buying, and the percentage of those trades is either suggesting they're further supporting the business, or if they're divesting of their equity in a large way, can be, again, that red flag. And you can find director holdings and history of director holdings in the corporate details section of Stock Doctor. Often in this section, you'll see directors exercising options as well. So, Kien, the question for the week is, what does exercising an option from a director's perspective mean?
Yeah, that's a great question, Tim. And let's take a look at Telix Pharmaceuticals as an example. So if you look at under the corporate details, you can see that in January, the CEO, Christian Berenbroek, he exercised 153,000 worth of options before buying the same amount in shares. But to understand this, you need to look at the remuneration structure of the director, which often includes the option for directors to purchase shares at a predetermined price.
Okay, so having a predetermined price allows the board to set a share price hurdle for the director to achieve, which is good. Accountability models. This share price hurdle builds a strong alignment of interest between the director and shareholders. Terrific. So again, just strong accountability. If they're not delivering for shareholder wealth in regard to appreciating share price, why should they be rewarded? Love it. Additionally, Kien, employee stock options are often tied to performance targets such as profit or revenue, ensuring that directors and employees are incentivized to meet key business objectives.
Yeah, that's right, Tim. So referring back to Telix, you can see that in January, Christian Berenbroek, he was able to exercise the option to purchase shares in the company, which would have been in the money at that time, Tim.
Okay, so some members might be wondering, Kien, why there is a 60% decrease shown on the screen. Note that this relates to a percentage change in the number of options held from roughly 254,000 to 101,000, rather than a drop in the actual shares held, Kien.
Yeah, that's right, Tim. You need to understand the distinction between the changes in the options versus the changes in shareholdings as well. But members should also note that the employee stock options can be cancelled due to either termination of employment or specific company policies, or if the performance targets are not met.
Yeah, fantastic, Kien. Well, that's a wrap for today, mate. Thanks a lot for sitting down and having a really good chat as always, and sharing your knowledge with our members. Really appreciate it.
It's a pleasure, Tim, and hope you stay well over the next couple of months.
Yeah, no, all those lurgies floating around, and there's a big lurgy in the market at the moment. That's that passive thing at the moment, which simply isn't making sense, Kien. Really makes us nervous. Again, it's a phenomenon that we haven't seen before. Who knows how long it's going to last, but it is really, really influencing that market momentum at the moment, which to me is totally artificial. But it is something that we're thinking deeply about it at Stock Doctor and Lincoln Indicators every single day. Because it's a very, very strange environment at the moment with so much macro fluctuation going on a daily basis as well. So really challenging, but again, we've just got to remain bottom up and select great stocks and mitigate risk where we feel it's appropriate. Don't forget that there's no Lincoln Live on Monday morning because of a public holiday. We'll be back online again the following Monday. And also don't forget to register your interest in Stock Doctor Platinum. That's out there now. Had a wonderful response to that premium service, very much a premium membership, where we really increase the accessibility to myself, Kien, and Matt, plus portfolio reviews, and also exclusive premium events where we can all get together with like-minded investors and share knowledge and obviously discuss stocks, which is the great thing we love to do. So yeah, that's a wrap. Thanks a lot again, Kien. Everyone stay safe. Have a happy, healthy, and prosperous week. Goodbye.